NN Group N.V, NNGR, listed on Euronext Amsterdam, is a comprehensive financial services firm with market leadership in the Netherlands and diversified operational strength across other European countries and Japan. The analysis indicates that NN Group currently presents a compelling investment case, characterized by exceptional capital strength, a clearly defined strategic growth trajectory, and a significant valuation discount relative to its major European peers. The company's financial foundation is robust, evidenced by an outstanding Solvency II ratio of 208%, 205% pro forma, as of the first half of 2025. This capital buffer supports a highly attractive and growing capital return policy, including a progressive dividend and an annual minimum share buyback of €300 million. Furthermore, the firm has set ambitious financial targets for 2028, aiming for 7 to 8% compound annual growth rate (CAGR) in operating capital generation (OCG) and free cash flow per share. The core investment thesis posits that NN Group is fundamentally undervalued. The stock trades at a price-to-book (PB) ratio of only 0.71x, which is substantially below the industry average and the multiples of comparable European insurers, which often trade above 1.5x. This significant discount, despite the firm's superior regulatory capital position, appears to incorporate market skepticism or undervaluation, primarily directed at the large, complex Dutch life insurance segment, which includes legacy closed blocks of policies sold prior to 2012. The analysis concludes that the primary catalyst for closing this valuation gap and achieving a multiple re-rating is the successful execution of the Future Ready operational efficiency program. The strength of the combined financial performance, strategic planning, and commitment to compounding shareholder returns warrants a positive assessment. The current share price fails to reflect the intrinsic value generated by the strong operational performance of its non-life and international segments, combined with the structural value uplift expected from digitization and share count reduction. Business segment deep dive and operational structure. NN Group's activities are managed across 6 reporting segments, providing both geographic and product diversification that stabilizes earning streams: Netherlands Life, Netherlands Non-Life, Insurance Europe, Japan Life, Banking, and other. Geographic and segment diversification. The firm maintains a strategic balance between its dominant position in the mature Dutch market and its high-growth international operations. Core market dominance, Netherlands Life. Netherlands Life represents NN Group's largest segment, consisting of Nationale-Nederlanden Life, AZL, and bfrank. This segment focuses heavily on the Dutch pension market, offering both group life and individual life insurance products. A significant structural component of this segment is the individual life closed block, which comprises a portfolio of discontinued products sold before 2012. The size and complexity of this legacy block are often factors contributing to market conservatism regarding NN Group's valuation, as complex long-duration liabilities carry latent risks, even if actively managed. However, the successful migration of the first pension fund by AZL onto its new platform, compliant with the new Dutch pension legislation, highlights the firm's capability to adapt and maintain leadership through regulatory change. Growth segment focus, Europe and Japan. Growth is increasingly sourced from the international segments. Insurance Europe and Japan Life have shown significant commercial momentum. In the first half of 2025, value of new business (VNB) increased by 11% in Insurance Europe, driven by higher sales volumes across multiple products and channels alongside a favorable product mix. VNB in Japan Life saw even steeper growth, surging by 25% following the introduction of a new long-term savings product. This robust VNB growth, particularly in international markets, is critical because it represents the future embedded value and profitability of the group. The successful deployment of capital into these underpenetrated, high-margin markets ensures that the company's capital generation is not constrained by saturation in the Dutch market. Banking segment. Nationale-Nederlanden Bank, NN Bank, a wholly owned subsidiary, serves as a Dutch retail bank providing products complementary to the core insurance offerings. While strategically aligned, the banking segment faced headwinds in the first half of 2025 due to lower interest margins, which partially offset strong operating capital generation from the insurance segments. B. Regulatory and accounting context. IFRS 17/9. The global transition to IFRS 17 insurance contracts and IFRS 9 financial instruments has been managed effectively by NN Group. Management publicly affirmed that the transition, completed on January 1, 2023, has had no material impact on the firm's strategy, established financial targets, capital management framework, or capital returns. The new standards introduce a change in the volatility profile of earnings. Under IFRS 17 and IFRS 9, increases in market interest rates impact both investment assets and insurance liabilities simultaneously, generally resulting in an offsetting effect that improves financial stability compared to the previous standards, IFRS 4 and IAS 39. This offsetting mechanism helps ensure that the group's underlying earnings power remains unaffected post-transition, which is crucial for maintaining confidence in the long-term OCG targets. 3. Financial performance and capital generation dynamics. NN Group focuses heavily on two core metrics for quantifying shareholder value creation: operating capital generation, OCG, and free cash flow, FCF. The recent performance demonstrates strong execution and establishes credibility for the highly ambitious 2028 targets. A. Operating capital generation, OCG, and free cash flow. In the first half of 2025, OCG increased by 6% year-over-year, reaching $1,020 million. This growth was predominantly fueled by a 10% increase from Insurance Europe and a substantial 15% increase from Netherlands Non-Life. FCF performance was also strong, reaching $863 million, positioning the company favorably to achieve its FY 2025 target of $1.6 billion. NN Group outlined significantly elevated goals during its Capital Markets Day for 2028. The firm is targeting OCG of $2.2 billion, up from an implicit 2025 target of $1.9 billion, and FCF above $1.8 billion. Critically, these new targets are explicitly stated to represent a compound annual growth rate, CAGR, per share of 7 to 8%. This emphasis on per-share growth is significant because it shifts the focus from purely organic earnings growth to strategic deployment of capital. Achieving a 7 to 8% CAGR per share requires a combination of strong operational performance and consistent capital contraction. Given the explicit commitment to annual share buybacks of at least $300 million, the firm is structurally embedding capital returns as a core driver to compound earnings per share and free cash flow per share growth, thereby reinforcing the achievability of the target even if organic revenue growth slightly underperforms. B. Underwriting and efficiency metrics. The Netherlands Non-Life segment demonstrated strong underwriting discipline, reporting a combined ratio of 91.2% for the first half of 2025. This figure falls at the low end of the segment's targeted 91-93% guidance range and represents high operational efficiency, directly contributing to the strong OCG growth observed in the period. Strong commercial results overall led to an increase in the operating result to €1,443 million, up from €1,329 million reported in the first half of 2024. 4. Capital strength, solvency, and risk profile. The financial safety and ability of NN Group to absorb shocks are measured primarily through the Solvency II regulatory framework, where the firm exhibits superior resilience. A. Solvency II resilience and evolution. NN Group's Solvency II ratio increased substantially to 208%, 205% on a pro forma basis in H1 2025, marking a significant rise from 194% at the end of 2024.
This strong increase was driven by organic capital generation, favorable market conditions, and a deliberate strategic action, the execution of a new longevity reinsurance agreement. By transferring longevity risk, the possibility of policyholders living longer than expected, the required regulatory capital for this risk decreases, thereby optimizing and strengthening the reported Solvency II ratio. This indicates sophisticated capital management rather than merely passive accumulation. The group aims to maintain a resilient balance sheet, targeting a stable pro forma Solvency II ratio of approximately 195% by April 2025. B. Interest rate and market sensitivity. As with all insurers, the Solvency II ratio is sensitive to market movements, particularly changes in interest rates and credit spreads on assets like government bonds and mortgages. In H1 2025, favorable market variances had a positive impact of 5 percentage points on the Solvency II ratio. The management of interest rate risk through strategic asset allocation, SAA, and specific policies is overseen by the NN Group Asset Liability OCO. Significantly, the firm reported that following strategic adjustments, including the issuance of €1 billion in undated restricted Tier 1 capital, Solvency II ratio sensitivities to non-interest rate market shocks decreased compared with the end of 2024. Furthermore, NN Group exhibits a defensive stock profile as measured by its low beta rating of 0.36. This indicates that the stock is less volatile than the market average, providing a degree of stability preferred by value and income investors. C. Debt and credit profile. NN Group maintains a robust investment-grade credit profile, holding stable ratings from Fitch, AA-A+, and S&P, A/BBB+. Its funding strategy is diversified, utilizing senior and subordinate debt at the group level and secured programs, covered bond, RMBS, and unsecured funding at NN Bank. V. Capital management and shareholder returns. NN Group's capital deployment strategy is a key component of its investment appeal, focusing on high and compounding returns to shareholders, which are directly supported by the consistent OCG and FCF generation. A. Progressive dividend policy. The company is committed to a progressive dividend per share policy. This commitment is validated by tangible growth. The 2025 interim dividend was €1.38 per ordinary share, representing an 8% increase compared with the 2024 interim dividend. Dividends are paid entirely in cash. The acceleration in dividend growth reinforces management's belief in the long-term sustainability and quality of the operational cash flows projected through 2028. B. Consistent share buyback programs. NN Group utilizes share repurchase programs as a core mechanism for capital return and managing share count. The firm commits to an annual open market share buyback of at least €300 million. This commitment represents an upward revision from previous targets and underscores the confidence in capital surplus generation.
A current €300 million buyback program commenced on March 3, 2025, with an anticipated completion date of December 31, 2025. These buybacks are strategically important for neutralizing the dilutive effect of stock dividends and, more importantly, are the primary driver allowing the OCG and FCF targets to be indexed for a 7 to 8% CAGR per share. The commitment to reducing the outstanding share count provides a structural lift to per-share metrics, compounding investor returns over time. V. Strategic outlook, growth drivers, and operational efficiency. Achieving the ambitious 2028 targets requires two engines: continued commercial growth in specific segments and successful execution of a group-wide operational efficiency transformation. A. Growth momentum and market adaptation. Commercial performance remains strong in targeted growth areas. The value of new business, VNB, increased significantly in Insurance Europe, plus 11%, and Japan Life, plus 25%.
This international growth is a result of improved distribution capabilities, particularly showing high momentum in countries like Greece, Poland, and Slovakia, and the successful launch of long-term savings products in Japan. Domestically, the Netherlands Life segment is effectively positioning itself for the long-term shift toward defined contribution (DC) pension models. The pension administrator, AZL, successfully transitioned its first pension fund to a new platform compliant with the new Dutch pension legislation, positioning the firm to capture a significant share of future pension transitions. B. The future-ready operational catalyst. The central strategic initiative driving the OCG and FCF targets is the Future Ready program, a comprehensive digital transformation effort designed to simplify IT infrastructure, enhance customer experiences through digitalization, and achieve profitable growth. This program involves extensive investment in digitalization, including the large-scale use of artificial intelligence (AI) across claims processing, distribution, and customer engagement. The financial commitment to the program is substantial, totaling approximately €450 million over the 2024 to 2027 period. This expenditure is projected to yield significant operational benefits, building up gradually to €200 million in annual benefits by 2027. The relationship between this efficiency program and the 2028 financial targets is direct and critical. The required increase in OCG from the implicit 2025 target €1.9 billion to the 2028 target €2.2 billion is roughly €300 million. The projected €200 million in annual benefits from Future Ready accounts for 2/3 of this required OCG increase. Therefore, the successful implementation and realization of these efficiency gains represents the single most important operational factor determining the achievement of the 2028 financial objectives and subsequent valuation expansion. V. Valuation analysis and peer benchmarking. NN Group's valuation metrics present a clear case of statistical undervaluation, suggesting a potential arbitrage opportunity relative to major European insurance counterparts. A. Core valuation multiples. Reported price-to-earnings ratios vary depending on the measurement period, ranging from 8.56x TTM November 2025 to 12.7x TTM October 2025. Analysts project a forward PE of 10.9x, but implicitly forecast that the stock will trade at a PE of 9.5x on its 2028 earnings to justify current price targets. The company's TTM net profit margin is reported at 9.17%. The most notable metric is the price-to-book P/B ratio, which stands at 0.71x MRQ. This ratio indicates that the firm is trading at a significant discount to its tangible net worth. Furthermore, NN Group's return on equity (ROE) of 6.24% TTM is below the industry average of 10.3%. This lower ROE is likely the fundamental reason for the depressed PB multiple. The market is pricing the stock based on the expectation that future returns on the existing book value will remain below the cost of capital. B. Peer group comparison. A comparison with major diversified European insurance peers highlights the extent of the valuation discount, particularly when contrasted against capital adequacy, Solvency II. The data confirms that NN Group trades at a substantial PB discount, often 50% or more, compared to its competitors, e.g. Allianz at 2.33x, Generale at 1.6x. This discount persists despite NN Group possessing an exceptional Solvency II ratio of 208%. The implication is that the investment thesis relies on NN Group successfully translating its strong OCG and the efficiency gains from the Future Ready program into a higher, sustained return on equity, which should eventually compel the market to re-rate the stock closer to 1x book value. C. Analyst consensus and price target analysis. Analyst confidence is generally positive, with a 12-month consensus price target of €63.98, based on projections from 14 analysts. Based on a cited share price of €57.36, this suggests an upside potential of approximately 7.74%. Major institutions, including JP Morgan and Barclays, maintain buy ratings with targets as high as €75 and €68, respectively. The analyst targets implicitly reflect the expected closing of the valuation gap as operational efficiency materializes and capital returns continue. C. 8. Key risks, headwinds, and scenario analysis. While the investment case is strong, several risks must be rigorously assessed, particularly those related to strategy execution and the macroeconomic environment. A. Strategic and execution risks. The most quantifiable operational risk lies in the execution of the Future Ready program. The attainment of the 2028 OCG target of $2.2 billion is heavily reliant on achieving the targeted $200 million in annual benefits from digitalization and efficiency savings. If the $450 million investment fails to deliver these projected savings fully or on schedule, the 7 to 8% OCG CAGR target would be materially impaired, likely leading to investor disappointment and subsequent downward pressure on the stock multiple. Furthermore, integrating acquired entities, such as the recently completed acquisitions of MetLife's businesses in Poland and Greece, requires focused management and capital deployment to ensure that realized synergies meet or exceed expectations. B. Regulatory and macroeconomic risks. The Dutch pension reform transition poses a material regulatory execution risk. While the initial successful transition by AZL is promising, the mass migration of pension funds to the new D system is a complex, multi-year process. Delays or unforeseen implementation costs could significantly impact the Netherlands Life segment, which is the group's largest business. Interest rate risk remains a factor. Although NN Group benefits from rising rates/spreads, which contributed positively to Solvency II in H1 2025, rapid or unexpected reversals in the interest rate cycle could negatively impact the valuation of long-term insurance liabilities and assets, requiring continuous management of the SAA. Competitive and market structure risks. NN Group operates in a fiercely competitive environment, facing large, diversified European peers like Allianz, AXA, and Generali. Sustaining commercial momentum in Insurance Europe and Japan requires continuous product innovation and effective distribution to defend and grow market share. Finally, the low beta of 0.63 suggests that while the stock offers superior defensive qualities and stability, it may trail the performance of cyclical stocks during sharp, broad market rallies driven by robust economic expansion. Investors should view NN Group primarily as an income and compound value play, where returns are generated through disciplined operational efficiency and high capital distributions rather than high cyclical growth. I. Conclusion and investment recommendation. NN Group N.V. is a financially secure and operationally sound European financial services company positioned for sustainable growth through 2028. The firm's capital base, demonstrated by the 208% Solvency II ratio, provides superior regulatory security and an ample buffer supporting high capital returns. The strategic path is clearly defined by the 2028 targets, aiming for 7 to 8% OCG and FCAGR CAGR per share. This goal is critically underpinned by the €200 million annual cost savings expected from the Future Ready digital transformation program and the robust annual commitment to share buybacks of at least €300 million. The firm's strong VNB growth in international segments, Europe plus 11%, Japan plus 25%, and excellent underwriting results in non-life, 91.2% combined ratio, further validate the operational foundation supporting these targets. The most compelling aspect of the investment case is the substantial valuation dislocation. Trading at a PB ratio of 0.71x, NN Group is severely discounted relative to its European peers, which often command PB ratios above 1.5x. This discount appears unwarranted given the company's capital strength and disciplined strategy. The central thesis for investment success rests on the management's ability to execute the Future Ready program successfully, thereby increasing the return on equity and triggering a necessary re-rating of the stock multiple towards its intrinsic book value. NN Group offers a highly favorable risk-reward profile characterized by high capital resilience, compounding shareholder returns, and strong potential for multiple expansion. The successful execution of the Future Ready initiative serves as the primary near-term catalyst to close the significant PB valuation gap and realize the current consensus price target of €63.98.